Hello, everyone, and welcome back to Girard's Monthly Market Update. I'm Senior Vice President and Wealth Advisor Jim Jacobson, and with us again today is Chief Investment Officer Tim Chubb. Thank you for joining us. Today, we'll review the recent and rather noteworthy shift in philosophy from the Federal Reserve and look to get an understanding of what impact that will have on investors and the economy going forward. So, Tim, at the conclusion of the Federal Reserve's meeting here in late August, a virtual meeting out in Jackson Hole, Wyoming, Fed Chairman Jerome Powell made some understated but potentially extremely important announcements regarding the Fed's position on interest rates, unemployment, and so forth. Help us understand in more detail what was said.
Sure, Jim. Good to see you. Like you said, Jerome Powell out in Jackson Hole really precast some of the changes to their approach and monetary policy framework, which I think we'll get some more details on later this month. But ultimately, I think it's helpful to kind of take a step back and really review what the goals of monetary policy and the Federal Reserve are, and that they'd like to achieve what's considered full employment, and B, achieve a level of inflation and which they would consider price stability. And so over time, full employment has been somewhere with an unemployment rate somewhere around the 4% or lower range, and inflation's been a target of somewhere around 2%, or exactly 2%, I should say. And now it's moving to somewhere around 2% as they make some tweaks to, like I said, their policy framework. And so as far as the employment situation is concerned, the FOMC's plan is only to respond to shortfalls from the maximum level of employment as opposed to all deviations, and essentially being less proactive as we get closer and closer to that maximum level of employment, or what we would consider full employment. As far as inflation is concerned, again, instead of it being a hard and fast 2%, and the FOMC gradually getting more less accommodative and more tight with monetary policy, either by stopping quantitative easing or raising interest rates and pulling on all the levers they have at their disposal to raise tight monetary policy. They're moving to a much more flexible approach for inflation targeting, called an average inflation target of 2%. So again, being less proactive, looking for inflation to average 2% over time, as opposed to this sort of proactive approach where instead of trying to have a soft landing and potentially over tighten monetary policy, they're looking to be much more accommodative moving forward.
It's an interesting set of comments, and from a short-term perspective, it might not seem to be that dramatic of a shift. A few words here or there, but just like the pilot of an airplane, when you adjust that direction by 1 or 2 degrees over the course of a 2,000 or 3,000 mile journey, it can make a really big difference in your destination. So, given that most of these current headlines that we're seeing today are dominated by politics and civil strains, things like that, what sort of shift in this philosophy? What does this really mean for investors? What does it mean to the people watching our program today, both short-term and long-term?
Yeah, so I think unfortunately for a lot of our clients who are especially in their retirement years, this is a continuation of what we saw coming out of the global financial crisis, which we called financial repression for savers, where long gone are the rates of CD rates of 4%, and a normalized environment where the economy is growing closer to that long run average. And as a result, the Federal Reserve needs to raise rates to help stave off inflation from becoming too unwieldy. And so, really the Fed's approach is telling us that investors are going to need to be patient, waiting for longer term interest rates to rise. It's going to be a function of economic growth. And I think one of the most common things that we're trying to explain to clients and investors is, just how growth and inflation and interest rates are all interrelated. And without, an economic environment where we're growing in excess of 3%, like the long-term average, without inflation, in excess of 2%, the Federal Reserve is not going to be raising interest rates. And so therefore, I think investors really need to get comfortable, with an environment where quote unquote risk assets will be in favor, meaning, growth stocks, as investors, pay a premium for growth in a growth starved world. As investors pay a premium for higher levels of income in the fixed income markets, and therefore that generally implies higher risk. In a world where the 10-year Treasury at the moment is somewhere between 0.7 and 0.8%. So I think investors just need to be again understanding of this is a function of low growth, and without large amounts of productivity growth or population growth, it's likely to be this environment for some time.
All right, Tim, that's good information to share. Thank you very much for your perspective on this. And one of the major themes that sticks with me is that we are in a fundamentally different scenario right now. And it's not a bad economic scenario. It's a little weird with the virus, of course, but it's just fundamentally different. And gone are the days of the Fed automatically raising rates when the economy begins to grow and unemployment comes down. And much in the same way that gone are the days that people travel by horse and buggy. Could we still get around with that method? Sure. But it's just not practical anymore. So one of the things that's often stated is that we overestimate the amount of change in the next 2 years, but we underestimate the amount of change in the next 10 years. And I think that's the scenario we're in right now. These changes that the Fed is talking about are not likely to change anything materially this week, this month, or even in the next year. But over the course of 10 years, it could be very, very dramatic. So I think one thing, too, is that investors need not fear these changes. Change is part of what we're all about. It's part of the economy. It's part of the world that we live in, and certainly part of America. So one thing that doesn't change is our commitment to helping investors meet the challenges they face today and the challenges they face in the future. So whether it's planning for retirement, grandchildren's education, or something as complex as the transition of a family business, we are here to help. Check us out on our website today at meetgirard.com. That's meetgirard.com, and see how we can help you successfully navigate the changes ahead. Thanks for joining us again today, everybody, and we look forward to connecting with you again.